The basic rules of recording transactions in double-entry bookkeeping. These rules are also known as the 3 golden rules of accounts, or the 3 basic rules of accounting. They are as follows. Debit what comes in, credit what goes out. This rule states that an increase in assets or expenses is recorded as a debit entry, while a decrease in assets or expenses is recorded as a credit entry. In other words, when an asset or an expense account receives something, it is debited, and when it gives something, it is credited. Debit the receiver, credit the giver. This rule focuses on the treatment of personal accounts, such as individuals or entities. It states that when a person or entity receives a benefit or gives something, their personal account is debited or credited, respectively. For example, if a company receives cash from a customer, the company's cash account, an asset, is debited, and the customer's account's receivable account, a personal account, is credited. Debit expenses and losses, credit income and gains. This rule pertains to nominal accounts, such as revenue, expenses, gains, and losses. It states that expenses and losses are debited, while income and gains are credited. For instance, when a company incurs an expense like rent or salary, the corresponding expense account is debited. Conversely, when the company earns revenue from sales, the revenue account is credited. These 3 rules help ensure that every transaction is recorded accurately and consistently in double-entry bookkeeping. By following these rules, the accounting equation, assets equals liabilities plus equity, remains balanced, and the financial statements provide a clear and reliable representation of a company's financial position and performance.